Hey friends, welcome back to the channel. I'm Iggy and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2023 Influential Tigers by Tiger Brokers with over 768,000 reads and 53,000 likes. I've produced over 650 videos with more than 300,000 watch hours as of December 2024. I also focus on regional and world economy topics. Today, we're diving into something that's been making waves in the REIT space, AIM's APAC REIT, or AAREIT for short. If you're curious about how properties can help grow your wealth, or you're already a REIT investor looking for insights, stick around because this one's packed with value. Let's break down their recent performance and why AAREIT might deserve a spot on your watch list, or even in your portfolio. First up, let's talk about their latest numbers. AAREIT reported a distribution per unit, or DPU, of 7.07 cents for the first 9 months of FY25. That's a 1.1% increase year on year. Now, you might be thinking, Iggy, that doesn't sound like much. But here's where it gets interesting. Distributions to unit holders actually grew by 4.3%. Yo, why? But because the unit base expanded, the per unit growth looks smaller. Think of it like this. Imagine you bake a slightly bigger pie, but invite more friends to share it. Everyone still gets a slightly larger slice than before. It's just not as dramatic as if you had fewer people at the table. On top of that, AAREIT's revenues climbed 5.7% YOY, and their net property income, or NPI, grew by 1.9% YOY. This growth is largely thanks to sustained positive rental reversions. In simple terms, tenants are agreeing to pay higher rents when leases are renewed or signed. So, here's my question for you. Do you prefer steady growth like this in your investments? Or are you someone who chases higher risks for higher rewards? Let me know in the comments below. Now let's zoom in on Singapore because this is where AAREIT really shines. In Q3 FY25 alone, they achieved 28.2% rental reversions on their Singapore assets. Over the first 9 months of FY25, their overall rental reversion rate was 21.2%. How did they pull this off? Well, they signed 19 new leases and renewed 41 others, covering about 127,299 square meters of space. That's roughly 16.4% of their portfolio's net lettable area, which is no small feat. This tells us two things. First, there's strong demand for their properties in Singapore. And second, AAREIT knows how to negotiate favorable terms with tenants. Picture this. It's like owning a prime piece of real estate in a hot neighborhood where everyone wants to move in, and they're willing to pay top dollar to do so. But here's something to think about. Can they sustain these high rental reversions moving forward? That depends on market conditions and tenant demand. For now, though, they're delivering solid results. Now let's talk about one of their smartest moves recently, the sale of 3 Totuk Link. On December 10th, 2024, AAREIT announced they were selling this property for $24,388 million. That's a 32.5% premium over its valuation back in March 2024. Why does this matter? Well, this isn't just about making a quick profit. It's part of their proactive asset management strategy. By selling properties at a premium price, they free up capital to reinvest in better opportunities or enhance existing assets. It's kind of like flipping houses. You sell one at a great price and use that money to upgrade another property or invest elsewhere for even better returns. The deal is expected to close in early 2025, pending approval from JTC Corporation. Moves like this show that AAREIT is serious about creating value for its unit holders, not just sitting on its existing portfolio. Speaking of creating value, let's look at their ongoing asset enhancement initiatives, or AEIs, at 7 Clementi Loop and 15 Tai Seng Drive, both located in Singapore. These projects are already underway, 50% completed at Clementi Loop and 20% at Tai Seng Drive, and are expected to wrap up by Q1 FY26. What makes these AEIs exciting is that they're projected to deliver an NPI yield of over 7% post-completion. That means these upgrades aren't just cosmetic, they're designed to boost income from these properties significantly. Think about it like renovating your home. Not only does it make the space more enjoyable to live in, but it also increases its market value if you ever decide to sell or rent it out. This strategy aligns perfectly with AA REIT's focus on rejuvenating its portfolio and maximizing returns for investors. Now let's touch on something every investor worries about: debt levels and leverage. Since raising $100 million through equity fundraising earlier in FY24, AAREIT has kept its leverage stable at 33.7%. Why is this important? Because stable leverage means less risk when interest rates fluctuate or market conditions change unexpectedly. Their weighted average debt maturity stands at 3.2 years, with a blended funding cost of 4.4% and an interest coverage ratio of 3.9 times. Here's another smart move. 70% of their debt is on fixed rates, so they're protected from sudden spikes in interest rates. This kind of financial discipline puts them in a strong position to seize market opportunities without worrying too much about debt-related risks. It's like locking in a fixed mortgage rate. You know exactly what you'll be paying every month, no matter what happens with interest rates outside. So now comes the big question. Should you invest in AAREIT? Beansprout has maintained a BY rating on AAREIT with a target price of SON 43, which represents an upside potential of around 10.85% from current levels. Why do they believe in AAREIT? For starters, they're actively rejuvenating their assets, especially in Singapore, which helps raise property values while keeping tenants happy. And let's not forget the strong demand for logistics and warehouse spaces driven by e-commerce growth and supply chain adjustments. If you annualize their 9 MFY25 DPU, AAREIT is trading at a yield of 7.4%, which is pretty close to its historical average of 7.3%. A decent return if you're looking for steady income from your investments. All right, folks, let me wrap this up with some key takeaways. First off, AAREIT has shown consistent growth through strong rental reversions and smart asset management moves like the sale of 3 Totuk Link. Second, their ongoing AEIs promise even better returns down the road with projected NPI yields above 7%. And finally, their stable leverage and disciplined financial management make them well positioned for future opportunities without taking on unnecessary risks. If you're considering adding them to your portfolio or just want to learn more about our rates, here are some next steps. 1. Always do your own research before investing. 2. Think about your financial goals. Are you looking for steady income or long-term capital growth? 3. Keep an eye on trends like e-commerce growth and supply chain shifts. They directly impact logistics-focused REITs like AAREIT. Got questions or insights? Drop them in the comments below. I'd love to hear what you think. Got questions or insights? Drop them in the comments below. I'd love to hear your thoughts. And if you found this breakdown helpful, don't miss my video on REIT's Breaking Point, where I dive into the challenges and opportunities facing Singapore REITs today. Hit that like button if you enjoyed this, and don't forget to subscribe for more wealth-building insights. Until next time, this is Iggy from the Investing Iguana signing off. Stay curious and keep investing smartly.